Everyone. Welcome to the recording of the first topic for the course. The title of the topic is The Need for Regulating Financial Reporting. It's going to be a brief run through of the topic, I think around half an hour or so. And I believe that we have gone through the module. So let me begin. Now, the learning outcomes of this topic, as stated in the module, is first, you should be able to understand the need and the necessity of regulating financial reporting, regulation of the financial reporting. Secondly, um, you are able to define agency theory and its extension. And the third one would be to describe the evolution of international financial reporting standards. Now, in the introduction, I believe that this would be the 10. We're going to look at these three areas or items, right? Accounting and financial reporting, agency theory, and also the IFRS framework. It's a very straightforward topic, right? And it is quite simple, easy to follow. Okay, there is nothing complex or difficult about this topic, right? Now, first and foremost, in terms of the definition, accounting is, I believe everyone is aware, knowledgeable, and to some extent have some experience, okay, in accounting. So if you look at the textbook definition, it is simply the process of three things, right? Identifying, measuring, and also communicating economic information about an organization. And the organizations are various organizations, not only profitable business organizations, but also non-profit organizations as well. And this may include NGOs, government units, education institutions, etc. Right? And under the broad umbrella of accounting, okay, we have two main subsets. Okay? Financial accounting and also managerial accounting. Financial accounting basically involves the preparation and also reporting of financial statements, okay, for that particular organization. Right? And it is basically preparing statements, okay, so that you can present it to users. And these users are mainly external users. So therefore, they are particularly concerned or work with the historical data, okay, of that particular organization. Now, managerial accounting is when you use the financial statements prepared, right, to make certain decisions, okay, involving planning, controlling, and as well as budgeting. Right? So you will use the statements prepared under the financial accounting, okay, to make these managerial decision makings for the company. Okay? So for example, if let's say you talk about moving forward, the company intends to chart a certain growth for the for the business, so they may involve in a certain capital budgeting decision, investment in fixed assets, for example. So they have to refer to the financial statements prepared earlier under financial accounting to make sound capital budgeting decisions for the company. And under managerial accounting as well, when it involves budgeting, we also have costing as well. Okay? Costing in terms of the products and services of the company. Right. So I believe you have had some exposure, okay, in terms of some basic accounting in terms of understanding the uh, balance sheets and financial statements, right? And later on in the subsequent topics, we will look at those financial statements, but our angle are primarily in terms of uh, using, okay, or understanding and also analyzing the financial statements instead of preparing them. Right? So this is not the cost of preparing the financial statements. This is more on how to use the financial statements for certain types of decision makings by the company. Right. Now, let's pause for a while and ask ourselves, why is it so important? Okay? As the title of the topic suggests, why is it important and why do we need, okay, to regulate financial reporting? Why there is a need? Okay? Why you need to regulate it in the first place? Right. So now, logically and also referring to the what have happened surrounding us. Maybe you have look at the news, right? In the internet, there are a lot of cases which involve the breach of governance or the lack of it for that matter. Okay, so corporate governance is very important. It's very vital, right? And without it, okay, it is difficult for company to sustain, okay, in the long run, and also in terms of attracting investors. Okay, but and also ultimately we are talking about the law here, in breaching of the law. So there are serious repercussions and implications. That's why regulation of financial reporting is a necessity. Now, if I can share with you, okay, so let me stop sharing for a while. Let me share with you the, okay, this is under the Securities Commission of Malaysia, okay, under the Audit Oversight Committee. Okay, this is just looking at some recent cases, the sanctions by the oversight Audit Oversight Committee under the Securities Commission of Malaysia. Okay, just to show you the gravity, okay, of the situation involving financial reporting. So let's look at this first case, okay, in which the action was taken on 3rd August 2020, okay, of this particular entity. So let's focus on the description of the misconduct, okay, failure to comply with relevant requirements of the international standards on auditing, right? And the action taken is prohibition from accepting any PIE, okay, or schedule fund as clients or preparing reports in relation to financial information, okay, or any scheduled fund. And there are several other actions, but look at the penalty is 35,000 ringgit. Okay, and PIE is a public interest entity, okay, which refers to the company or the entity that is being audited. Okay, right, and secondly, it's quite similar, right, and few others. Okay, so there's every year there are cases, right, and you can refer to this website to refer to those other cases in other years. And these are just the public listed companies. Public listed companies. When you talk about the companies that are not listed, okay, it's even more serious and even greater in numbers. Okay, so that is just to show an example and also a perspective on the financial reporting regulation. Okay, so let's continue on with the agency theory, which was the root, okay, why financial reporting is important in the first place. Okay, so this agency relationship, as you have read, okay, in the module and also from based on your own experience and reading before, Okay, agency relationship is normal. Okay, it's a conventional relationship because in any business you have the owners, okay, or the investors, and also you have the party which manages or run the business, run the company. And since the investors or the owners can't be there every day, okay, 24/7 to run or manage the company, we are talking about corporations here. So they have to appoint the management team, right? Through, of course, the BOD, Board of Directors, which then appoint the management, right? And often, more times than not, these two entities, which are the owners or the investors versus the management, they have different priorities. Okay? They have different objectives or goals, hence resulting in conflict, what we call the agency conflict. Right? Now, this conflict, okay, would result in few measures, okay, which are taken by the management, which can erode the value and affect the shareholders' wealth. Okay? So, because of this different objectives or different priorities, right? The owners or the investors need to mitigate. They need to do something about it in order to control this agency problem. So the mitigation measures, they come in various forms, but almost all of them involve cost. And this later on are termed as what we call the agency cost in order to mitigate the agency problem. So it can be in the form of controlling mechanisms, reporting, or it can be in terms of perks, bonuses that are tied to performance, or it could be in terms of ESOS. Okay, you offer the management some ownership or stake, a certain percentage of stake in the company, so that you want to minimize, right, the conflict or the problem, okay, so that it is more aligned, okay, so that the uh, priorities or the objectives and actions by the management are more aligned with the uh, owners, okay, or the shareholder. Now, in looking at the agency theory, we have two approaches, two main approaches. One is the shareholder value approach, where you, as mentioned, as I have discussed earlier, okay, it is between the shareholder or the owners and also the management as the agents. So your focus or your focal point would be on the wealth of the or the value, okay, of the shareholders or the investors. Whereas the stakeholders approach is more uh, general. It is not just confined to just the owners or the shareholders. You also look at other parties that are stakeholders of the company. Maybe you look at the suppliers, the um, communities, right, the government, etc., market at large, right? So that is basically the agency theory in short. Okay. Now let's continue on with the IFRS, okay, which is the International Financial Reporting standards. Okay. Now in this topic, we are more uh, interested or concerned in looking at the general overview of the IFRS framework, right? So as you have read, okay, it is IFRS is just a standard, right? A set of standards that serve as a common rules, okay? And it is issued by the International Accounting Standards Board, which is under the IFRS Foundation. Okay, and recently there is another, okay, arm. Okay, so in addition to the International Accounting Standard Board or ISAB, we have the International Sustainability Standards Board or ISSB. So that's why in public listed companies' annual reports. Okay, it is compulsory for the public listed companies to also include the sustainability report, which is under the purview of international sustainability standards reports. Right now, and why is it established? Of course, it is to you want to develop or create a common lingua, or what we call a common accounting language or reporting format, right? And this is so that uh, the reports or the financial report um, can be understood easily, transparent, okay? And this is important because to ensure reliability, and so that we can trust them. Okay? We can trust them, and it signals that the company has integrity, okay, as far as reporting their financial performance are concerned. Right? And under IFRS, there are quite a number of documents or resources that you can refer to. Okay? And of course, you can go to the website itself, the IFRS website. But what I want to share with you today is that this one accounting firm has developed is what we call the IFRS Pocketbook, okay? Which is quite handy. Okay, so I'm going to share with you. Hold on. Okay, so this IFRS Pocketbook, okay, is prepared by Deloitte, right? So I'm going to share with you, okay, in the LMS. Okay, don't worry. I just want to pinpoint to what are contained, basically contained in this pocketbook. Okay, so they describe, in general, okay, the financial statements and reporting. What are they? Okay, and this reporting entity composed of what, and consists of what, which item, and what is the framework that is being used. And more importantly, right, they define, okay, and they define and also provide the some overview of the elements that are contained in the financial statements. This is for ease of reference, okay, by those who prepare the financial statements. So if you notice, starting from page 26 here, okay, you have the definition and description of the items or the elements, such as assets, liability, and all the other items as well. Okay, and not only these are handy and practical for accountants, but also for students like yourself. Okay, to once in a while go and refer to this kind of pocketbook prepared by this accounting firm, right? And they lay out the, in terms of IFRS, we have 17, and from the earlier IAS, okay, we are still using up until I think IAS 41. Okay, and they also provide the interpretations of the IFRIC. Okay, that it is quite thorough here. Okay, and they also provide an example, okay, at the end of the pocketbook, okay, in terms of the financial statements. Okay, so I will share with you this IFRS pocketbook prepared by the Deloitte accounting firm. Right now, another thing is, okay, I want to share with you is the IFRS guidelines in Malaysia. Right, there's quite a variety, quite a few sources that you can refer to, but the one I'm sharing today is quite simple and straightforward. This is still under the IFRS. Okay, and it I enlarge it a little bit. Okay, so the as far as Malaysia is concerned, okay, they describe the financial reporting requirements, okay, for Malaysia, and as can be seen here, right, companies that are incorporated or entities that are incorporated under the Companies Act, okay, they fall under the purview of the Companies Commission of Malaysia, right? So which is under the Companies Act 1965, which I will show to you briefly afterwards. So more times than not, most of the companies fall under this regulation, okay, under this Companies Act 1965. Okay, and those which involve finance and banking, okay, there is additional, okay, purview of Central Bank of Malaysia, right? And companies that are publicly listed, okay, are under the purview of Companies Commission of Malaysia, okay, SSM. Okay, right. Sorry, this is the general companies. The public listed is uh, the Securities Commission. Okay, not Companies Commission is the Companies Act, but the Securities Commission is for the public listed companies, right? Under here, Securities Commission. Okay, so it lays down the in terms of the governance, okay, and in terms of the regulation, okay, what needs to be prepared when and to who, to which particular authority that those statements need to be sent to be reported to, right? And we have electronic filing record, electronic filing as well, right? And they lay down the in the form of a checklist, okay, so that companies can check. So this is quite handy as well, right? And the last document that I want to share with you, right, is the Companies Act. Okay? And this is quite important because more times than not, most companies will have to refer to this act. Okay? And share. It's quite lengthy, about 500 pages. Okay? They have 7 parts. Okay? And most of the parts which companies have to refer most frequently are, I think, part 5 and 6, okay, which one under the management and administration as well as uh, finances, okay, under the financial reporting and accounting, right? And in fact, this is the an important handbook or Bible, if you may, right, that companies need to refer to, and even accountants or auditors, okay, need to come back to this act, okay, this handbook to refer in cases where there are discrepancies or there are confusions or there are things that need to be resolved or ascertained in the company. Later on in the case study that we will discuss in class, right? So there are a few issues, okay, or problems that arise in the case study, okay, which one of the ways that the problems can be enlightened is for us to go back and refer to this Companies Act to check on few things, okay, which we will discuss in the case study. Okay, so I I believe most of you have seen this. Okay, it's just that maybe you did not or have not used it extensively. Okay. All right, so we go back to our okay. So that is in short, right? Topic 1. So I've introduced to you some basic definitions and overview of accounting. Okay? And under the umbrella of accounting, we have looked at financial accounting as well as managerial accounting. Okay? Then we look at the question of why the need of financial reporting, and I've shared with you some cases involving financial reporting uh, discrepancies or breach of the regulation as shown in the Securities Commission website earlier. And then we have looked at the agency theory. I've explained to you what agency theory is, right? And how it relates to the need for financial reporting. Then we have looked at the IFRS framework in general, okay, shortly, right? And I've shared with you the pocketbook prepared by Deloitte, and that is the broad international or general framework. And then zooming into Malaysian IFRS framework, I have shared with you the condensed sort of a checklist format of IFRS framework in or requirements in Malaysia. Okay? And also we have looked at the Companies Act, okay, the 500-page Companies Act, and uh, this is the most important reference point, okay, of not only the company's regulatory but also by the accountants and auditors, okay, when it involves financial reporting. Okay. So that's all for the short video for the first topic, and I'm looking forward to seeing you all in class where uh, we'll be discussing our first the case study number 1. Okay. That's all. Thank you and have a good day.